Micron just had a banger of a quarter. Let's talk about it.
Yeah, they sure did. It was really good. Although maybe we should say expected to be really good. They are sold out of capacity. They just booked up all their 2026 capacity. Let's take a look and we'll give you some tips on how to value this business as well, because it can be quite tricky, especially if you're just looking at earnings per share, or even not just the GAAP earnings per share, even if the adjusted earnings per share is the metric you're watching. There's some extra items you need to know, which is where we should mention the sponsor of today's video, our friends over at fiscal.ai.
Fiscal.ai gives you all the tools that you need to analyze business, look at some of the metrics that we're talking about here today, and make the best decisions for your portfolio. You can get 15% off any paid plan, including their Pro plan, with the link here on the screen or in the video description, fiscal.ai/CSI.
And shout out, their quarterly numbers get updated very quickly over at Fiscal. We'll come back to this chart here in just a moment and explain what you're looking at: cash from operating activities, CapEx, free cash flow, and that little purple sliver there. What is that? We'll talk about this accelerated computing, re-acceleration of the sales market. We're not going to update these end markets before we enter the new year. So get a good look. This is where we're at right now. Let's talk about Micron.
Nano Banana has helped us out by making the Q1 fiscal 2026 earnings highlights. Micron had record revenue at 13.6 billion, GAAP net income 5.2 billion, highest ever free cash flow 3.9 billion, which we're going to
adjusted free cash flow.
Adjusted free
It's
cash.
an adjustment to the adjusted metric. We'll explain why that is. On these specific end markets, as it pertains to the previous slide, accelerated computing, what we're really looking at is the top two items there on the right under business unit strength and outlook. Cloud memory, 5.3 billion in sales in the last quarter, in the November 2025 quarter. Core data center, 2.4 billion revenue. These have been mixed up. These segments have been reshuffled a bit, but essentially this is in its totality the data center market. The cloud memory is more like the traditional business, and core data center would be more like the high bandwidth memory that gets co-packaged with GPUs or accelerators. Could be NVIDIA, could be AMD, could be those Google TPUs co-designed with Broadcom, that sort of thing.
Here is the outlook for Micron, and then the Q2 2025 highlights on the bottom. Outlook is on the top. For comparison's sake, we have that last year's on the bottom. Their revenue is expected to be 18.7 billion next quarter. That's pretty impressive. So that would imply a year-over-year revenue growth of 132%. And then the GAAP adjusted earnings per share growth of 418% and 440%.
Okay. Pretty incredible looking numbers. Huge sequential quarter-over-quarter revenue and earnings growth for Micron. But we need to look at one more profit metric, because what's happening here is Micron sales and GAAP earnings per share and adjusted earnings per share have rallied. However, both of those metrics do not account for capital expenditures, because we are very much in a period of CapEx growth so that Micron can meet the current wave of demand. So let's take a look at that. In blue is cash from operations, and in orange is the CapEx on equipment, which is essentially, you can think of as the money that goes to the Fab 5, ASML, Applied Materials, Lam Research, Tokyo Electron, KLA Corp. So all good news. This continues to reinforce the outlook for those companies that they're going to have a banner year in 2026. And that's why those stock prices for the Fab 5, the fab equipment providers, has rallied. So what that means for Micron is, on a free cash flow basis, they're actually not as profitable at the moment as the earnings per share and adjusted earnings per share would seem to indicate, because the CapEx expenses have not caught up yet. The depreciation, the elevated depreciation schedule has not caught up yet on GAAP earnings. At any rate, Casey, you mentioned the adjusted free cash flow. Where did that come from exactly? Basically, what Micron did when they said adjusted free cash flow of 3.9 billion is they took free cash flow of just over 3 billion and added back the US CHIPS Act incentives that they were paid in the last quarter, which came in at 878 million. That's where the adjusted free cash flow comes in. So just to clear that up, what that means, hopefully that's helpful in doing a valuation analysis.
As you made a note there on this chart, the stock repurchases are limited by the CHIPS agreement for one more year, for a total of 2 years. They're limited by how much stock they can repurchase. And so what they did with that money is actually paid some of the debt down. You can see on the right side, debt coming down. That's the red and orange bar right there, just over 11.5 billion in debt.
Not bad. Not bad at all. So Micron is back to having a little bit of net cash and investments on balance over and above the debt. Since they're limited on stock repurchases, they did repurchase 300 million in the last quarter, but they're still going to be limited on that portion of shareholder return. Wouldn't be surprised to see them continue to pay off debt in the next year until they can ramp up the stock buybacks. But I think maybe we should now address valuation and what kind of expectations we should have for Micron headed into 2026, because our view still stands that come the end of calendar year 2026, we would expect to see the start of a cyclical slowdown, not a downturn. We're not calling for a downturn, but a cyclical slowdown in AI infrastructure and CapEx. That would be our general baseline expectation. I'm not saying that we're going to have a down year in 2027, but that's just our baseline cautious assumption right now, is to expect a slowdown from the 20% to 30% semiconductor end market sales growth rate overall. Valuation for Micron.
So currently trades around 36 times trailing 12-month enterprise value, free cash flow, plus the CHIPS Act rebates, or in our estimate, 22 times next 12 months, which implies a 60% free cash flow plus CHIPS growth in the next year.
Perhaps that's a bit cautious, especially given the massive revenue growth guidance Micron just gave, but we're also factoring in for the exit of the Crucial business. And that actually brings up another important point. If we go back to the slide, the Nano Banana slide, there might be a little bit of misunderstanding here on the mobile and client revenue under business unit strength and outlook. Mobile and client, that it's not the entire segment that Micron is exiting. Micron has a separate brand called Crucial that sells memory products directly to consumers. So if you're building your own PC, for example, and you might want to buy the SSDs for your PC, or maybe an external memory device, SSD, it's that direct consumer business only that Micron has decided to exit. It's not the whole segment there, the whole mobile and client, 4.3 billion revenue in the last quarter. They will continue selling memory to PC and laptop makers, to smartphone makers. So just to clarify that, but our little bit of a cautious outlook on free cash flow growth does imply the exit of that Crucial business, as well as the fact that Micron is still building its fab in Idaho, still expanding its fab in Idaho, and won't break ground on the fab in New York until this next year. So they are capacity constrained. They are relying on higher pricing at this point. That's the caution there. And then also because it's a cyclical business, we're waiting to see what would happen in 2027 with those growth rates as well. That's certainly not taking anything away from the company. This was a very strong quarter, and the quarter over quarter guidance was pretty incredible. So I think the AI trade While it has hit some bumpiness, especially for Oracle and all the businesses surrounding Oracle as of late, the AI investment play is still very much valid in our view as we head into the new year.